Good morning, everyone. This is Kirk here again at Option Alpha. It is the first trading day of October, the first day of the fourth quarter. So it's pretty early here, about 7:20 in the morning, and wanted to get this video out to you guys just to update you on kind of where things are going right now. Obviously, a lot of volatility, a lot of uncertainty in the market, but I think we're doing good. I'm very confident in the positions that we have on for October. Haven't added November obviously because of the late sell-off in the indexes last week, which is fine. And I think that we're definitely going to start adding a lot of those positions this week. Obviously, get back into some credit spreads, of course, and kind of use up some of the cash that we've been saving up over the last 2 months here. So I'm pretty happy with what we've done overall. All the positions have been fairly light. The only position that is relatively close right now is OIH, of course, and we'll go over that in this video because I know people had a lot of questions on it. But everything else seems to be really, really straightforward. A lot of room to go, even with the recent sell-off. I wanted to start this video this morning real quick with just a look at the VIX, and obviously the VIX has been staying in this trading range above 30 for the past 2 months now. Pretty impressive on the VIX. I gotta hand it to it. If you actually look back at the last 5 years or so, barring this huge drop in '08, of course, then there's only been a couple times where the VIX has gotten up into the high 30s, even 40s, and as soon as it does, namely back in '07 and '08, when it did, it would only get up there for a couple days, maybe 1 or 2 days, and then quickly dip down below. So the fact that we've gotten up there and stayed up there is a really good opportunity, I guess, for option traders. Premiums have continued to stay high, so that's why you'll see a lot of things are just kind of overinflated right now. And this is a really good time to be an option seller and writing credit spreads and those kinds of strategies that take advantage of negative volatility. If you actually do some digging, and I was looking on Bloomberg over the weekend doing some digging, there's actually been a total of 166 times where the VIX has closed above 40 since it started trading in 1990. And so what we found on Bloomberg doing some research over the weekend is that actually if you aggregate those times where the VIX traded over that level for about 30 days, which is almost where we're at here, where it's continuing to stay in this top region, that the S&P actually had about a 3% move over the next 3 months and a 19% move up over the next year. So we could actually be looking at what quite possibly could be one of a quick bottom over the next couple months. Now, I don't know about the whole year thing. Again, that's aggregated over a long time, over the last 20 some years. So I don't know if we're necessarily in for a major bottom here, but definitely a short-term bottom. And I think that that's really the name of the game here. I think that fear is overextended. Obviously, people are being a little bit irrational right now. Every fear gauge is to the is way oversold. You even take a look at something like Bollinger Bands, acceleration bands on the indexes, and you can see that we're starting to get back into that territory of being way overextended to the downside. So that doesn't mean that there's no room to the downside. There's obviously more room to the downside. That's the easier path right now because of all the news. But it means that there's definitely going to be some bottom feeding coming in. And so we have to take advantage of that. I think that right now, selling puts is the best thing you can do. You can get far away from the market and take on some good premium right now with the VIX being high and volatility. If you look at some of the positions that we have, obviously, on the RUT, we have the one credit spread for the month, and that's the 500-490 credit spread. You can see lots of room between this. We really just took a step back from the markets, give ourselves plenty of room, very conservative position, obviously. So even if the market continues to see some pretty good falls over the next 2 weeks, which is all it really has until expiration, then we're going to still be okay with this position. It's going to be really safe. Same thing with some of the other positions that we have, more importantly on the naked portfolio. The 90 SPYs, again, very safe, far from the market, even with last week's sell-off. The indexes could continue to sell off pretty substantially and we'd still be okay. IWM, of course, same thing. Way down here at 50 on our strike price for this one for October. So you can see that that's been our whole mantra, is just get away from the market. Even if we're selling against the prevailing trend right now, the big thing for me is just the distance between the strike price and the market. You can see we can get a big gapping distance between those two right now, versus if we tried to go on the call side, we'd be up here around 75, 77, and a quick rally could really take out that position. So I'm not too keen on selling calls right now into this downtrend. I'd rather take the more favorable, more conservative puts, even though they don't feel like they are. I know some people that I was talking to over the weekend said that, they don't feel like the more conservative trade, but they definitely give you the extra room that you need to get away from the markets. Now, the November options, which we're going to start entering into this week, are really low right now. I'm talking, 40s on the IWM, on the S&P. They're down back around 80. So again, we're continuing to step away from the market and give ourselves plenty of room, give the market plenty of room to do all the kinds of volatility stuff it wants to do. We're not day traders. We don't want to be in that business. The one position that we do have that's getting a little bit close is the 95 OIH. And you can see that the OIH is really overextended to the downside. Again, if I throw up any of the acceleration bands, the Bollinger Bands, we've had a huge breakout on the acceleration bands on the OIH. Very overextended to the downside. So I don't think that it's going to continue at this rate. Even if it does, I think the strategy is going to be to either roll this lower in the same contract month, so that would be October, or to even roll it out to the next contract month, because premiums are so high right now that that might be a prudent option for us, is to roll it to the November options and continue to get even further away from the market. So taking this strike and moving it much further down, say around 85 or so, giving us ample room. So I know that a lot of people, when I entered this recommendation, were trading options around 110. And I had mentioned in the video and in the post, if you go back to the post, that anything closer than 105 was pretty risky trading. And you can see why, because it doesn't take a big move to knock this thing out of those 110s and 105s. You can see it's already trading at 103. So I think the prudent decision, as always, and this really drives home the point, is to make yourself more conservative with your trading. Take a backseat to volatility and risk, right? Don't get all close to the market so you can get those high premiums. You want to take the slow, consistent premiums. Have time to actually think about a logical decision to either move this position, roll it lower, roll it to the next contract month, etc. Right now, we have plenty of time. Volatility is really increasing right now, since we're under the 20 days now. So time decay is going to be a big factor here in a lot of these options. So it's going to be really good, really interesting to see where it goes. Futures this morning are trading slightly higher. They're regaining some of the loss overnight. Here's the S&P, which is only down about, it's basically flat almost. Same thing with crude. Crude is regaining some of the momentum it lost overnight. So it's going to be an interesting week. I think that if you look on the economic calendar, and this again is based off of the platform that we have here for you guys. If you look on the economic calendar, the big things next week are going to be non-farm payroll and the unemployment rate, which come out both at the end of the week. So if we actually look at the historical history of the unemployment rate, you can see that there's been a couple times back in May, June, July where the unemployment rate actually missed. We've been doing fairly good the last 2 months, August, September, where the unemployment rate either beat expectations or was at expectations. So I think that we may be in order for a miss. That's what my gut's telling me. I think we may have a miss here in the unemployment for October, which would be really devastating to the indexes. So I'm not sure if that's factored in yet, but that's obviously where we might go. Last chart I want to get a look at here real quick is just this average S&P quarterly change. And you can see that since 1928 and the last 20 years, the fourth quarter has been really good for the indexes. So third quarter obviously was pretty tough, and we saw that this month. Most of the indexes were down double digits for the quarter, but I think the fourth quarter is going to be really strong, at least for the indexes, and regaining some of these losses. Not necessarily getting back into a bullish trend, but definitely a strong bear market rally here. So as always, I'll continue to keep you guys updated. Look for trading alerts either tomorrow or Wednesday, depending on how things go today, and happy trading.